Understanding equity funds is crucial for anyone looking to grow their wealth over the long term. So, what exactly are equity mutual funds? In simplest terms, an equity fund pools money from multiple investors. This collective pool of money is then invested in a diversified portfolio of stocks. Think of it as a basket of stocks managed by professionals. These professionals, known as fund managers, use their expertise to select stocks, aiming to achieve the fund's investment objectives. These objectives can range from growth to income generation. When you invest in an equity fund, you're buying units of the fund. Each unit represents a portion of the fund's underlying assets. The value of your investment in an equity fund fluctuates with the stock market. As the value of the stocks held by the fund rises, so does the value of your units. Conversely, if the stock market declines, your investment value will also decrease. This inherent link to the stock market makes equity funds a potentially rewarding investment avenue. However, they also carry a certain level of risk. In India, the Securities and Exchange Board of India, or SEBI, plays a crucial role in the regulatory landscape. SEBI is the regulatory body overseeing the securities market, including mutual funds. Their regulations ensure transparency and investor protection within the industry. One of SEBI's key regulations for equity funds pertains to the minimum investment in equities. According to SEBI guidelines, an equity mutual fund must invest at least 65% of its total assets in equities. This mandate ensures that equity funds maintain a significant exposure to the stock market, in line with their objective of generating capital appreciation for investors. The remaining portion of the fund's assets can be allocated to other asset classes, such as debt instruments and money market securities. This allocation provides a degree of diversification and helps manage risk. SEBI's regulations extend beyond asset allocation. They also cover aspects such as fund management, disclosures, and investor education. These regulations are designed to foster a fair and transparent investment environment, safeguarding the interests of investors in the equity fund market. When considering equity funds, it's important to understand the different management styles employed. The two primary approaches are active management and passive management. Active management involves a hands-on approach by fund managers. These managers actively select stocks and time their market entries and exits. Their goal is to outperform a specific benchmark or index. They leverage their expertise, research, and market insights to make investment decisions, aiming to generate higher returns than the market average. In contrast, passive management follows a more index tracking approach. Passive funds, often referred to as index funds or exchange-traded funds, aim to replicate the performance of a specific market index. For instance, a Nifty 50 index fund would hold the same 50 stocks in the same proportion as the Nifty 50 index. The choice between active and passive management depends on your investment goals and risk tolerance. Active management has the potential for higher returns, but also comes with higher fees. Passive management offers lower costs and aims to match market returns, making it suitable for long-term investors seeking diversification and market-linked growth. Section 4. Are equity funds right for you? Assessing your investor profile. Before diving into the world of equity funds, it's crucial to determine if they align with your investment profile. This involves considering your risk tolerance, investment horizon, and financial goals. Equity funds, by their very nature, are considered higher risk investments compared to fixed deposits or bonds. This is because their value is directly tied to the fluctuations of the stock market. Investors with a higher risk appetite are better suited to handle the potential volatility of equity funds. They are also more likely to stay invested for the long term. This long-term perspective is essential for riding out market downturns and benefiting from potential growth. Furthermore, your investment horizon plays a significant role. If you have a long-term investment horizon, such as 10 years or more, equity funds can be an ideal choice. This extended time frame allows your investments to potentially grow and weather market cycles. However, if you have a shorter investment horizon, equity funds might not be the most suitable option. Finally, your financial goals should guide your investment decisions. If your objective is capital appreciation and building long-term wealth, equity funds can be a powerful tool. However, if you prioritize capital preservation or require regular income, other investment avenues might be more appropriate. Section 5. Equity versus debt funds, a comparative analysis. When choosing between equity and debt funds, it's crucial to understand their fundamental differences in terms of risk and potential returns. Equity funds, as we've discussed, invest primarily in stocks. Stocks represent ownership in companies. Their prices can fluctuate significantly based on various factors. These include company performance, industry trends, and overall market sentiment. This volatility translates into a higher risk profile for equity funds. However, it also comes with the potential for higher returns over the long term. On the other hand, debt funds invest in fixed income securities such as government bonds, corporate bonds, and treasury bills. These instruments offer a fixed rate of return over a predetermined period, making them relatively less risky compared to equities. Debt funds are generally preferred by investors seeking stable income and capital preservation. However, their potential for high returns is limited compared to equity funds. The choice between equity and debt funds ultimately depends on your individual risk appetite, investment goals, and time horizon.